Now we'll start the adult course. We're going to start with credit creation and the money multiplier equation, and then move on to the differences between commercial and investment banking.
Hi everybody, let's in this video understand a primary function of banks, which is credit creation. How banks can create money out of thin air and increase the money supply just like that, it seems. Very, very interesting concept. A lot of people think this is really quirky. It's not. It's very sustainable. A process known as fractional reserve banking. Right, so we have our bank in the middle there. We know that one of the key functions of a bank is to bring together savers with borrowers. Savers will deposit money in banks and will gain a rate of return back from banks as a result. Banks will then create loans from those savings and will lend to borrowers and will charge an interest rate to borrowers as a result. The whole idea is that the interest rates charged to borrowers will be greater than the rate of return given to savers. The difference will be the profit that banks make, and we know that their primary objective is to make profit.
So once again, how do banks stay in business? It's because they take your deposit, they take a portion of that deposit and make them loans for other people to borrow. While they do give you what they call, quote, interest, it's actually return for your savings account or for your checking account, or now they have these money market accounts, they'll give you a return while they're charging the borrowers an interest rate. The interest rate is always greater than the return that they give you, and whatever money is left over between the interest rate and return, that's the for profit that the bank takes. That's how they stay in business.
Great, that's how it works. But let's dig deeper into this process. Let's understand this idea of fractional reserve banking. Well, let's take an individual saver who deposits £100 in the bank. The bank will then decide and make a very careful calculation of how much of that £100 needs to stay in the bank, knowing that the individual saver is unlikely at one time to demand all of their savings back. More likely that individual saver will come and want to withdraw some of that £100 to finance whatever spending in the economy that saver wants to do, but unlikely that £100 will be withdrawn at once. So the bank decides that maybe only £10 of that needs to be left in the bank in case that saver comes and demands some bit. The rest of it can be lent out to borrowers, £90. Borrowers want money to spend in the economy. When they spend, that generates income for somebody else, at which point that £90 can end up back in the bank as a deposit again. All of a sudden, we are increasing the money supply. Where only £100 existed before, we've now got £90 on top, so £190 in the money supply, compared to just £100 before. Remember,
I'm going to stop there for just a second. This looks like a shell game to me, at least on the surface. Because remember, you had to give up 90 of those pounds to get it to the lenders, to spend it, to get it back into the bank. So until, not the lender, the borrower. So until the borrower pays back what was lent to them, technically that £100 doesn't exist in the bank. Only 10 of those pounds still exist in the bank. Meaning that overall, you still just have £100, or dollars, since we live in America, in the bank. So again, this is sort of a shell game, and at the very end, he'll explain how you can make the entire shell game completely collapse. But we're talking about credit. We're not talking about physical money. We're talking about what's on the ledger books.
remembering that deposits form a key part of the money supply. So now £90 are back into the bank. The bank will think, okay, only £9 of that I need to keep in the bank just in case that individual saver comes back and demands some of their savings. The rest can be lent out to individuals, lent out to borrowers who will then buy goods and services. That generates income for somebody else, and eventually that £81 will come back in the form of a deposit in the bank, and that process keeps happening and happening and happening. So you get the idea of how deposits can be turned into loans and they will come back into the bank as a form of deposits. This process continues. What we can actually work out is how much extra money can be created from an initial deposit using an equation called the money multiplier. And the money multiplier equation is this. The money multiplier is 1 over the reserve ratio, or the reserve requirement. In the UK, the reserve ratio is not set by the Bank of England yet. There's no regulation in place at all. But in the US, there is a regulation of how much commercial banks must keep in their banks when deposits are made. And that is 10% in the USA. In the UK, it's not there. In my example, you can see that the reserve ratio is 10%. Any time deposits have been put into the bank, 10% of it has been kept in the bank, the rest has been lent out. So in my example, the money multiplier is 1 over 10%, i.e. 1 over 0.1, which gives you a value of 10. So if you multiply the initial deposit by 10, you get £1,000. And that is the money supply as a result of an initial deposit being put in a bank. £1,000 of money now exists in the economy. To work out the...
Again, this is sort of a shell game until the borrower has actually paid back what they owe to the bank. That money only exists on paper. It doesn't actually exist in real life. But nevertheless, you can take $100, because we live in the United States, and essentially turn that into $1,000, creating credit.
Increase in the money supply from a £100 deposit with a money multiplier of 10, you need to take away £100 from whatever figure you get. So 10 times 100 gives you £1,000 minus the initial deposit, which is £100, because that already existed, means you have £900 of brand new money in the money supply. So
Do you see what he did there? He said you cannot count the initial investment because that's basically double counting. So when you actually figure out how much you've multiplied the money by, so it's in this case a money multiplier of 10, which is the max you can get in the United States. You multiply that to the original investment, which was $100. Again, we live in the United States, to get $1,000 total that has been, quote, created. Minus the initial investment, which was the 100, leaves you with $900 of credit. Not actual money yet until it's been paid back, but credit that is in the bank.
That is fractional reserve banking, guys, and this happens on a daily basis. When we put our money into bank accounts, some of it is kept in the bank and the rest of it is lent out to individuals, and that keeps happening in a circle, creating new money out of nothing, it might seem. But this is very sustainable as long as we all have faith in banks, as long as we all don't go to the bank at once and demand all of our money back. If we do that, we know banks don't have all that money. They're lending a lot of it out to other individuals. That's called a bank run. So unless we do that, this system will be absolutely fine. If we all go to the bank and demand our money, that's called a bank run, and that's when this fractional reserve system will completely break down. So the whole idea of fractional reserve banking is that it's based on trust. It's based on faith that individual savers will never at once come and demand huge chunks of their savings back at one go. As long as we don't do that, this system is very, very sustainable, and it leads to increases in the money supply, which can facilitate growth in the economy. Thank you so much for watching, guys. Hope that makes sense. Very interesting stuff. I'll see you all in the...
That's why when you hear, oh, they had to shut down the bank because there was a run on the bank, they'll actually close banks in various countries that are in trouble to prevent runs on the banks, so that this whole idea of credit creation and the so-called credit that's been created doesn't collapse like a house of cards. Now that should make sense.
The next video.
Hi, my name is...
All right, let's move on to the next. Any questions? Oh, there we go.
Hi everybody, let's in this video understand the key differences between commercial banks and investment banks, something I'm sure interests loads of you out there. Well, let's look at commercial banks first. Very simple functions that commercial banks have, like NatWest in the UK, Lloyds, TSB, these are all classic examples of commercial banks. Their functions are so simple: to accept savings, as we've learned, from those that have got excess cash, to then lend out to borrowers, so to convert those savings into loans and to lend out. In that sense, to act as financial intermediaries, right? So the idea is give a smaller rate of return on savings compared to the interest rate charged to borrowers, and that way they can make profit. That's their very simple business model, acting as financial intermediaries, bringing together savers with borrowers, right? But also to allow payments from one agent to another, so you know you can divert funds from your bank account to businesses, for example, if you want to pay for goods and services. That's a very important function that commercial banks have as well. They also offer advice, insurance advice, financial advice. That is another key function that commercial banks have. But you see, very simple, not hugely profitable, the commercial banking side. What's much more profitable is what investment banks do. Let's understand that. What investment banks get up to is much more lucrative, much more profitable, much more exciting. Pure investment banks out there, example, Goldman Sachs, for example, JP Morgan. It's rare to see pure investment banks these days. You often see a mix between investment banking side and the commercial banking side. We'll talk about that a little bit later.
That's very important. You're actually going to want to go to your bank and figure out, are they a pure commercial bank or are they a commercial bank combination investment bank? He'll explain why that's important at the end.
With respect to systemic risk. But one key function of investment banks is proprietary trading, prop trading. And this is taking any excess capital that investment banks are sitting on and investing it, trying to get a better rate of return. Maybe buying shares, buying bonds, buying derivatives, any kind of financial assets that investment bankers think is going to generate a better rate of return for the investment bank. So taking profits and trying to make more profits out of them, basically. Very high profile, very lucrative, very, very profitable. And therefore, if you work in that part of an investment bank, boy, you can be making big, big, big money. Market making, this is essentially ensuring that markets can exist. So for example, if you want a second-hand car, if you go to a second-hand car dealership, you can get a car from there. Similarly, if you want to sell your car, you can go to a second-hand car dealership and they are going to buy your car up, right? It is a place where the market exists. The same thing can be said of investment banks. They're a place where bonds, shares can be bought and sold on behalf of lenders and borrowers. It's a place where if you want to lend money, you can buy bonds from investment bank, you can buy shares from there, and other financial products from there. And if you want to borrow, that you can go and issue bonds, for example, through an investment bank, shares through an investment bank. So in that sense, they create a market. You always know in an investment bank there are going to be shares to buy, there are going to be bonds to buy. In that sense, they're a market maker. We then look at some advisory roles. Mergers and acquisitions is a key advisory role that investment banks have. So if you have a company that's looking to take over or to merge with another company, they might go through an investment bank for advice, basically. What kind of advice? Well, advice on when to go through that merger or that takeover. How to structure that deal, if it's a cash buy, if it's a share buy, whatever it might be. Due diligence to make sure that everything is A-OK with the firm that a predator or the first firm is looking to take over. Is everything okay with that takeover firm? There are no kind of cobwebs or hidden secrets with that firm. To make sure that all the paperwork is done and meets whatever the regulators want, that's important. And to make sure that it goes out into the media in a very successful way, in a positive way as well. So investment banks can give very important advice when it comes to mergers and acquisitions, charging a big fee in the process. But also when it comes to new issues, so if companies want to issue bonds to raise finance or issue shares to raise finance, they can go to an investment bank to gain help. Investment banks can actually put them into contact with people that are looking to buy these bonds and buy these shares. Investment banks can publicize them. Investment banks can write them up for them and issue them for them. So important roles, when it comes to publicity, they can literally make brochures and sell these bonds and sell these shares on behalf of the issuers, which is very important when these guys want to raise finance. They can also get involved in something called underwriting. So if nobody wants to buy the new issues of shares or bonds that companies are offering, investment banks can buy them all up on behalf of that company and then charge a percentage fee on top of whatever that value is, making huge sums of money. That's known as underwriting. So these are some of the core functions of investment banks. I've left a couple out because they are very technical.
Remember this too, a bond is nothing more than an IOU, basically saying you'll give us a little bit of money, we'll give you a percentage interest rate per year, and it's simple interest, it's not compound interest, and that at the end of maturity of the bond, that money is given back to whoever it was taken from.
Technical, you don't need to know them, just need to know these core functions. Nowadays you don't really see pure commercial banks necessarily and pure investment banks necessarily. Yes, there are one or two examples. What you tend to see more of are banks like HSBC and Barclays that will engage in both kinds of activities. They'll have a commercial bank side or a retail side, and they'll also have an investment bank side. Now that's important for you to know, because then the risk of systemic risk is much greater, whereby failures on one side, especially the investment bank side, can bring down the other side. And therefore the risk of a bank failure is much higher. And as we know, as so many banks are interconnected, they've got liabilities and assets that other banks may have. The risk of one side failing, bringing down the other, could then bring down the entire financial system. That's the idea of systemic risk. So the more you merge these two activities together in one bank, the greater risk there is of the bank failing. And because all banks now are interconnected in some way, the risk of therefore the whole financial system coming down, i.e. what happened in 2008, is much greater. That's why we say that merging these two sides together increases the risk of systemic risk in the financial system, where the whole financial system can come down. Thank you so much for watching, guys. Hopefully you found that very interesting and you understand it now. I'll see you all in the next video. Commercial banks are...
So I'm gonna briefly pause it for a second here, because this is really important. Most banks have merged and have become both commercial and investment banks. If you want to protect your money, keep in mind that the individual typically will need what the commercial bank is offering, and in some cases the individual, for example, market making and so on. But for the most part, businesses are going to be most interested in an investment bank. Now, investment banks generally tend to have a greater deal of profit, but that profit comes with greater risk. If you want don't come to me for financial advice. I'm not a financial advisor, but based off of what I'm seeing here, if you want a bank or a credit union that is more fireproof, if you will, from failure, you are going to go to them and ask them what all their functionalities are. And you're going to want to choose a bank or a credit union that has the least investment banking capabilities and the most commercial banking capabilities as a place to store your money. Now, later on, if you want to withdraw that money and toss it in the stock market or something like that, you'd of course want to go to an investment bank. But you might want to actually consider air gapping your money by trying to find the greatest percentage commercial bank or commercial credit union that you can find. Again, don't come to me for financial advice, but just putting two and two together, it would make sense to keep your money in a more traditional commercial style bank.